Goldman Sachs' latest report on India. The brokerage house expects growth to pick up and inflation to accelerate over the next 2 years, forcing the RBI to hike interest rates. That's the forecast for the next year. Darshan Mehta has more on that. Darshan.
Well, so they've come out with this report. They've come in on 3 countries. So there's Indonesia, there's Philippines and India. So we'll focus what Goldman Sachs has to say on India, and they've divided it into several parameters. As far as the GDP forecast is concerned, in FY18 they believe it will be 6.4%, and in FY19 they believe that the GDP growth will come in at almost 8%. So that's the broad theme that they're talking about. In terms of what they speak about the GST, they're saying that the negative impact of the GST will fade in over the coming year. There were 200 items in which the GST rates were cut significantly, and over the next 3 to 6 months the effect will be seen on GST, so that they believe is extremely positive. And they're saying that on the bank recapitalization, what they're saying is the first point they say is that this actually unlocks credit, and secondly it boosts private investment. So that's their view that's coming in on the bank recapitalization. Also lowers borrowing cost is what Goldman Sachs is indicating. Now they've also come out with other parameters. First of all, what are the key driving parameters for the Indian market? The wage hike that has come in will actually aid the consumption demand for India going ahead, and the focus on infrastructure, affordable housing and all will support investments that will lead to GDP growth that will come in. The risks that they also point is that any kind of delay in GST related effects and the bank recapitalization not done properly could derail the story, is the risk factors that they have put in. The other factors is inflation forecast. For FY19 they believe it will be 5.3%, and for FY18 they will be almost 3.4%. So they expect inflation to move because of food prices and commodity prices that will push inflation much higher. The other factors that they speak about in the report is core inflation. For FY19 they believe will be 4.8%, and for FY18 they believe will be 4.4%. So that's their forecast that they are coming out for. The other factors that they speak about is a rate hike. So they believe a 75 basis point rate hike can come in by mid 2019 in these 3 parameters. So in third quarter of FY18, fourth quarter of of 2018, and the second quarter of 2019. So that is how they see a 75 basis points increase that could come in as far as the RBI is concerned. So that's their view. The current account deficit, according to them, will remain manageable. That's their view on the CAD. And as far as the rupee is concerned, they expect the rupee to appreciate significantly against the dollar from levels of 60 right up to levels of 62, 63. So that's where they see that will come in. And the current account deficit to widen to 2.1% of the GDP in FY19. So broadly, they've given a parameter, across parameters, they've given their view on India, and this is what they had to say.
I think they're just taking if Moody's was taking a leap of faith, these guys are, probably jumping above many bridges. And actually, there are various contradictions in their report. So if you look at the composition of GDP and the breakup that they're talking about, so they're talking about, headwinds or tailwinds coming in from the wage hikes. That should feed into consumption. But if you look at the breakup of their GDP numbers, where they're really betting is a marked change in the investment environment. So they're saying private consumption growth goes from 7.1, so 8.7 in FY17, 7.1 in FY18, and then goes to 8.3, so normalizes. Government consumption actually comes down from 10.8 in the current year, which they're forecasting, to 9.3. But they expect fixed investment growth to go from 3.7% to 9.5%.
Wow.
That's a really big jump. And that would mean that within a 12-month period, you have to close the entire underutilization gap. And we have spoken to people who have said that in the consumer industries, perhaps there is investment starting to pick up, but that is not, that is not material at the macro level. At the big level, you need the steels, the powers. Those are the guys who drive investment. Power capacity utilization is under 70, way under 70%. So, to make this assumption is a little bit, it's an assumption at this point in time. Anybody who's making forecasts about the next 2 years is throwing darts. Nobody knows how the economy is going to settle post-GST.
But a doubling of private investment in over a 12 to 14 month period, however positive you feel about an economy and its underlying fundamentals, a doubling of private investment, unless they know something that we don't.
Yeah, exactly.
Right?
It's entirely
unless
possible.
CEOs have confided in Goldman Sachs and said, I have a plant and I
haven't told anybody about it.
But I'm telling you about it, and please put it. That seems to be a stretch, and therefore I think predicated on that, an 8% number for FY19 sounds like a tall task.
And the other thing there is a gap in is their inflation forecasting. So, they talk about the fact that they expect this to be largely driven by food inflation, which is going to start normalize. So there is going to be that year-on-year base effect on food inflation. Obviously, that will come in. They're saying core inflation will remain relatively moderate. I would be surprised, you can't rule it out, but I would be surprised if the RBI starts to respond so rapidly to turn the cycle around by 75 basis points in a period of 12 months in response to normalizing food inflation, if it is not feeding into core inflation.
Is it just food inflation that
so they talk about food inflation,
oil price inflation.
They talk about oil prices, but they say core inflation, they expect it to increase to 4.8% year-on-year in FY19 compared to 4.4% in FY18. That's not a huge jump in core inflation. And core has been in that 4.4 to 4.8. In fact, it's come back to 4.4 only in recent months. It was at about 4.8 earlier. I mean, you can't rule out rate hikes. I think even within the MPC, you've had Michael Patra talk about the need for a rate hike. I don't know if it's going to be a 75 basis point, sort of turn in the cycle that quickly. But perhaps, oil, of course, as things change, could change things.
But that would not feed into core.
Oil will feed into core through transportation, and
only
it all gets passed on.
Also, got to keep in mind that Goldman is in a different stage when it comes to their assumptions on the global growth forecast as well compared to a lot of others. So Goldman, I think last week came out with the note saying that they believe that calendar year 18 for the world will be substantially stronger than what calendar year 17 was. And when we spoke to Sajid yesterday or day before, Sajid himself said that while they may have those assumptions, but JP Morgan internally believes that calendar year 18 will have some challenges, which will make 2018 be a lot lower than 2017. And the couple of other brokerage notes that came out over the last 1 month, I don't remember which ones, but they also said that the party may not really last well into calendar year 18 as well. So Goldman is well, I won't say a minority or a majority, but it's got a starkly contrasting view on the global growth forecast as well. They are a lot more bullish, I would say, than what a lot of others are. And maybe that's what's feeding into their three economies of Asia forecast as well. Because I think they're starting off the report saying that there is solid growth momentum that will kick into each of these three economies.
They say it's a non-consensus view.
So it's the season for year-end reports and year-forward reports, right? I think Bank of America has put out a report saying the end of the bull market in 2018. This is, of course, with reference to US markets. And in that story, there is a reference to how Goldman Sachs was terribly wrong this year because they were wrong on the S&P, and that they had expected that, the S&P will not move this high. And the S&P crossed, I think, all the Goldman Sachs targets by the middle of the year. So maybe Goldman Sachs was a little bit more bearish and is now turning bullish a little late in the cycle.
Overcompensating.
Yeah, possibly.